each of which historically has provided approximately one-third of the group's revenue. A fourth business division which focuses purely on providing distribution channels for the oil and coal sector was established 2 years ago and in 20x8 began to grow quite rapidly. It is forecast to provide 12% of the group's revenue this year, growing to 15% in 20x9. This division is performing particularly well in developing economies. In recent years, revenue has grown steadily, based mainly on growth in some locations where e-commerce is rapidly developing. This year, revenue is projected to decline slightly, which the group attributes to increased competition as a new distribution company has taken some of the group's market share in a number of countries. However, the group management team is confident that this is a short-term drop in revenue and forecast a return to growth in 20x9. Then innovation. The group has invested in automating its warehousing facilities, and while it still employs more than 250,000 staff, many manual warehouse jobs are now performed by robots. So that is the innovation that they have in store. Approximately 5,000 staff were made redundant early in this financial year due to automation of their work. Other innovations include increased use of automated loading and unloading of vehicles and improvements in the technology used to monitor and manage inventory levels. Integrated reporting. The group is proud of this innovation and is keen to highlight these technological developments in its integrated report. The group finance director has been asked to lead a project tasked with producing the group's first integrated report. The finance director has sent the following request to the audit engagement partner for the integrated report. We would like your firm to assist us in developing our integrated report and to provide assurance on it, as we believe this will enhance the credibility of the information it contains. Specifically, we would like your input. We would like your input into the choice of key performance indicators, that is the KPIs, which should be presented, how to present them, and how they should be reconciled where relevant to financial information from the audited financial statements. The publication of an integrated report is not a requirement in the jurisdiction in which the group is headquartered, but there is a growing pressure from stakeholders for an integrated report to be produced by listing reporting entities. If Bisson and Company accepts the engagement in relation to the group's integrated report, the work would be performed by a team separate from the audit team. So this is the Exhibit 3, which has extracts from consolidated financial statement and statement of financial position. You have goodwill, other intangible assets, all of them. Then you have current assets, and you have total equity, then you have statement of P&L also. Okay, this is a statement of P&L. Now notes to the extracts from the financial statements are available, wherein goodwill says goodwill relates to the group's subsidiaries and it is tested for impairment on an annual basis. Management will conduct the impairment review in December 20x8, but is anticipated that no impairment will need to be recognized this year due to anticipated growth in revenue, which is forecast for the next 2 years. In March 20x8, the group acquired an 80% controlling shareholding in Lynx Company, a listed company located in a foreign country, for consideration of $351 million. Management's determination of goodwill arising on acquisition is shown in Exhibit 4. Other intangible assets. Other intangible assets relate mostly to software and other technological development costs. During the year, $35 million was spent on developing a new IT system for dealing with customer inquiries and processing customer orders. A further $20 million was spent on research and development into robots being used in warehouse and $5 million on developing new accounting software. These costs have been capitalized as intangible assets and are being amortized over a 15-year useful life. Equity and non-current liabilities. A share issue in July 2008 raised cash of $100 million, which was used to fund capital expenditure. Non-current liabilities including borrowings of $550 million, last year it was $500, and provisions of $100, last year it was $120. Changes in financing during the year have impacted on the group's weighted average cost of capital. Information from the group's treasury management team suggests that the weighted average cost of capital is currently 10%. Financial performance. Revenue has decreased by 3.7% over the year due to the new competitor in the market taking some of the group's market share. Other operating income comprises of all of these. Then operating expenses is these. These are operating expenses. And this is Exhibit 4, determination of goodwill on acquisition of links. These are the notes for determination of goodwill. So when we do that, we'll read it. Extract 5. Extract for audit strategy prepared by Vulture Associates in respect of the audit of Links Company. The 2 points below are an extract from the audit strategy. Other sections of the audit strategy include the audit strategy assessment, have been reviewed by the group audit team, and are considered to be satisfactory. Links Company is projected to be loss-making this year, and the group audit team is confident that sufficient procedures and going concern have been planned for control effectiveness. We will place reliance on internal controls which will reduce the amount of substantive testing which needs to be performed. This is justified on the grounds that in the previous year's audit, controls were tested and found to be highly effective. We do not plan to retest the controls as, according to the management, there have been no changes in systems or the control environment during the year. Internal audit. Links Company has offered the services of its internal audit team to help perform audit procedures. We are planning to use the internal auditors to complete the audit work in respect of trade receivables, as they have performed work on this area during the year. It will be efficient for them to perform and conclude on the relevant audit procedures, including the trade receivable circularization and evaluation of the allowance for trade receivables, which will instruct them to carry out. So now look at requirement A. Which says evaluate the audit risk to be considered in planning the group audit. You should use analytical procedures to assist in identifying audit risk. You are not required to consider audit risk relating to disclosure, as this will be planned later in the. Basically, you have to give the audit risk by using the analytical procedures. For that, you have to find out ratios. So this is question 1A. Let's begin with that. What is this? You have to prepare it like an email only. So they have sent an email to you. You also have to reply like an email. So write down briefing notes. to Maya Craig audit engagement partner, right? From audit manager, subject Eagle Group audit planning and introduction. So first I'll give the introduction and then I'll start with the A part. So what is the introduction? The introduction will say these briefing notes are prepared to assist with planning the audit of the Eagle Group for the financial year ending December 2018. The notes contain an evaluation of the audit risk which should be considered in planning the group audit. The notes also recommend the principal audit procedures to be used in the audit of goodwill which has arisen in respect of a newly acquired subsidiary. Finally, the group finance director. So this is going to give you an introduction of all the requirements that they have asked. The group finance director has requested our firm to provide a non-audit service. Which one is that? In relation to the group's